Well, good morning and welcome to Consider This. And if you're watching us live, you will notice that it's 5 p.m. It's Tuesday evening. We're certainly not in the morning, but this is still a radio show that airs live, or not airs live, but airs at 6 a.m. on WIBC and many other stations around the country on Saturday mornings. But if you're joining us tonight, I am your host, Joe Clark.
And I'm Angie Kinzer.
And we're happy to have you along. And it is evening, even though we always talk about the morning. So go ahead.
Yes.
You told me. So the whole point of the show, in case you're new to it, is we want to give you things to consider. Angie's job, my job, the Financial Enhancement Group, the sponsor of the show's job, is to help you reduce financial regrets. We want to take care of people who don't want to worry about their money so that you don't make inefficient financial decisions that lead to frustration and sometimes even devastation. So go ahead, Ange.
Well, I just saw something that was interesting. The AARP has come out with a new guide for tipping. And meaning, like during the coronavirus, and it says the economic fallout may have reshaped our etiquette for tipping. And so I was just curious. So
Really?
I was reading it, yes. And 62% of the people say that they're giving more to services now.
I am.
Such as hairdresser, pharmacy.
I am not eligible for AARP, even though they sent me their nasty little card in the mail.
Did they?
I sent it back. My wife said, "Do you realize all the coupons that are attached?" I said, "You keep yours." She, like you, she's the same age.
Well, they're trying to strongly advise, to try to match delivery and things like that with in-house dining.
Yeah, I get it.
And so some of these places like Grubhub, DoorDash, I don't know if you've ever used any of them.
Kaylee and Kinder, I think both, and Kale, my son-in-law. So both my daughters and my son-in-law, I think, have all delivered stuff where you pick it up at Meijer, or you pick it up at Walmart, or you pick it up at Kroger.
Well, these places will bring you straight from Wendy's.
Yeah, and I don't. Well, one, we don't eat fast food
to your door. Well,
right?
yeah.
So I have
true.
not. I've not. So I don't know that one, right? But we've gone and picked up food, and we do. Some of the places automatically apply the tip that we go to.
Yeah, that's what they were saying. They're setting up like the default at 15% at some of these places.
Yeah.
So, but I guess I just started thinking, I mean, you talked about your daughters. Would you want them to be a food delivery person?
No, one's in nursing school and one does home health care, and but that doesn't mean that it's not necessary.
No, it's totally necessary. It's just sometimes I worry about that job, and it seems like now it's kind of making a comeback.
I get that. It's kind of funny. I do boxing.
Yeah.
And so I have my trainer, and at 6 a.m, it's not quite dark anymore. But at 6 a.m, I'm worried when I leave that, she's downtown in the middle of Anderson and the door's open and she goes, "I just trained you in boxing." Right? So she is probably okay. Hey, welcome to Consider This. We are so glad you're here. Lots and lots to talk about. Give Angie a call at 800-928-4001. We'll take a break and be right back.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider This program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, YourLifeAfterWork.com. Now let's get back to the show.
Well, good morning and welcome back to Consider This program. I am your host, Joe Clark.
And I'm Angie Kinzer.
So one of the interesting parts that I used to get from my Purdue students, so I've been in the financial services world since 2 weeks before the crash in 1987. That means a long, long time, over 32 years.
Yes.
And there's a lot of different ways to do what it is that we do. I prefer to work with a team where everybody has a salary, has a 401k, has health insurance that wants it, where everybody is on the same page and works that way. And that's the way we built the Financial Enhancement Group. And I will tell you, if you decide you want to hire a financial advisor or a financial planner, I put together a checklist that said, hey, if you don't want to hire me, here's the questions that I would ask, right? I mean, I built the company the way that I would want it designed if I was going to hire me to be able to do it.
Right.
So get the checklist. It's free. You can give Angie a call at 800-928-4001 or just go to our website, right?
Yep.
At yourlifeafterwork.com.
Yep, we have an easy button.
It's an easy. I like easy,
I do too.
right? I mean, it's just the way it is. So anyhow, when you're trying to figure this out, it's a simple way to go. But when I taught the capstone course, the senior level course at Purdue University in financial planning, they got a 4-year degree in that. A lot of the people were going to work for places that sell stuff. Mm-hmm. And, when I started 32 years ago, I had to sell stuff. I get it. I wish I hadn't have had to do that. We certainly don't do it today. But, the first 5 years of my life, it was about finding products that matched what people would say yes to. And, fortunately, the last 27 years, it's been about providing professional advice and guidance. And, we're able to hire people so that they don't have to go through that. My point of all of that is that when people were getting hired, without understanding how self-employment works, Angie, they would say yes to the total without understanding what was left. Mm-hmm. Right. So when you become a self-employed individual, there are 2 different types of taxes that we all pay. One is what you pay as based on the amount of income that you make. That's what we call your marginal rate.
Okay.
Not everybody pays that, by the way. And this is what creates some political problems because a lot of people don't make enough money to ever get to the marginal rate. But the second part is FICA and FUTA. It's Social Security and unemployment tax. Mm-hmm. I pay 7.65% of your salary into Social Security.
Yep.
You pay 7.65% into Social Security. It's kind of like an even match, right?
Okay.
When you are self-employed, you pay both sides of that ticket.
Okay.
Right? And a lot of people don't understand that. So go ahead and start with your questions.
Well, I mean, a lot of people that we know may be retired and do a little freelance work on the side, or they may still be working and do
Mm-hmm.
it. So we did have some questions. So I thought, I looked it up, and these are some tips you may need to know. But first of all, I know you were talking about the different kinds of companies. How are taxes paid differently from, say, an LLC and an S Corp to a sole proprietor? What are the differences?
Well, you would want to add one more into that. You would want to add a C Corp, which is a regular corp, right? LLCs, sole proprietorships, S Corps, all are known as pass-through entities, right? So a sole proprietorship's not technically an entity, but an S Corp is, an LLC is, right? And what a pass-through means, it goes directly to your tax return. But again, that's only in regard to your marginal tax rate, mm-hmm. right? So this has nothing to do with the rest of that, right?
Okay.
This is just, that's your marginal rate. It's flowing through to your tax return. A C Corp, and this is what confuses a lot of people when you talk about double taxation. And again, this is a political hotbed, right? I mean, it's way too early in the year for me to really start getting overly protective of the tax code. So I will try to be cautious. But when you hear the word double taxation, what that means is that the corporation is taxed, and then Angie gets the money, whether it be a dividend or whatever it is, and then she gets to pay taxes on it again. Right?
Well, is that what someone calls a self-employment tax?
No.
That's
No. So self-employment tax, again, is on your own return, right? So Angie doesn't like it when I say this, but she's a flipper, as opposed to a stripper. She is
What?
she likes to buy houses, fix them up, does things that I can only imagine that anybody could possibly do, because I would hire that done so quickly I wouldn't even think about trying to do drywall. I can only imagine what it would look like, right? So you buy a house, you fix it up, you sell the house for more than you paid for it.
Yep.
Right? If it took longer than a year for that to happen, it's a long-term capital gain. If it took less than a year for that to happen, it's a short-term capital gain.
Yes.
Now, if you made your business out of that, the IRS would say this is your job. And some people would argue that you would have a profession in doing that and would have to pay self-employment tax, right? And self-employment's what goes directly to FICA and FUTA, Social Security, and to Medicare taxation, right? If I hired you, so let's say you were, Joe's contractor, right? And I hired you to do those, I would pay half of that Social Security tax and you would pay half of that Social Security tax. If I was a big corporation and we were a C Corp, right, I would pay you and nothing for you changed in that matter, right? Nothing at all of that changed. But remember, as a C Corporation, at the end of the day, if we have profit, as a C Corporation, I can make the decision to buy more buildings, to hire more people. I can make the decision to invest in more capital expenditures, or I can pay a dividend. If I pay a dividend, I have to pay taxes on the dividend as the corporation. And then when you get the dividend, you've got to turn around and pay the taxes again. That's where double taxation comes into play.
Now, most self-employed people or freelancers pay their taxes quarterly. Is that required, or is that just a good idea? Or
I wouldn't say I would disagree with the statement that most do that. I would agree with the statement that most should do that.
Okay.
I remember in Halloween, I got the notification in 1988 that I was being audited.
Is that scary? We talked about that last week.
It really bothered me.
Okay.
But I got the notification, and it was for Halloween, and I remember showing up, and I remember the auditor telling me that I owed money, even though it cost me money to work. I had lost money. We did not make any money. We went way into debt to start this company. Didn't make any money, but what I owed was the Social Security tax. It was the FICA and the FUTA, right? And so I would always encourage somebody, if you're going to go into business, if you're going to be self-employed, you want to make sure that you're at least setting that money back quarterly. So you have two entities. You have the state and you have the feds, right? The federal government. You don't want to get behind with either one of them. The state is actually a little less forgiving than the federal government. So you want to make sure that you stay on top of it. The Social Security tax, the FICA, and the food is all going to the feds. But you want to really make sure that you're paying into the state side, what is owed, and to the best of your ability quarterly if you can.
Is there a minimum, like, let's say you made $200 for the year doing something for you?
There is a limit that you can make and not owe any tax, and so that's where you don't have to figure out filing.
I think it's $400. If you make over that, is when you have to file.
So there are different rules there,
Okay.
and this is where it becomes confusing, and it changes all the time. So without getting there, if I paid you money, I'm supposed to send you a 1099, which a 1099 form is the best thing for you to think of as money in motion, right?
Right.
Lets the government know that money went from my pocket to your pocket. So if I pay you a certain amount of money, I'm supposed to file a 1099. If you make a certain amount of money, then you're supposed to file a tax return. And where they try to net that out is if it would be a net experience, why make you go through the trouble, right? Based on all of the credits, the standard deduction, and everything else. If you're not going to have to owe anything at the end of the year,
Yes.
right? Then why go through the problem of even having to mess with the documents? And I can't tell you that the IRS has ever said, Joe, with absolute authority, that's the rule. I just tell you that that's what it kind of looks like to me.
Well, that was my other question about the 1099. So every single person that pays you has to file that. Now, do they have to get that to you by the end of the year, or how?
It is supposed to be. So there's two different money in motion forms is the way that I would look at it. that if you really want to understand taxes, you need to know. One's a 1099,
Yep.
right? That's where you were going to get your interest, dividend, where you're going to get capital gains, where you move money from one retirement account to another retirement account. Some of them are taxable, some of them are not. So you'll have these little letters behind them, and there's a good guide on the back side of the 1099 form that helps. But like 1099-R stands for reportable. That means it's taxable income most of the time. Every now and then I see one that's a 1099-R that's not reportable, and I kind of wonder, but I'm not a CPA, got a lot of great people that we work with that are in that environment, and we'll let them do that. The other one's a K1. So a 1099 you're supposed to have by January 15th.
Okay.
And what's happened since 2003 with the change of qualified dividends, what's happened is a lot of 1099s get recalled and resent out because people have wrong data. K1s are supposed to be, I think, March 15th. And it's why you have so many people who file extensions anymore. I mean, they almost always fail to have the data to you in time. So,
Got it.
hey, I hope that was helpful and useful. You're listening to Consider This Program. I'm Joe Clark, along with Angie Kinzer. Give her a call, 800-928-4001. Get signed up for your Next Steps meeting. We'll help you understand this stuff better than today.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This Program with Joe Clark.
Well, good morning and welcome back to Consider This Program. I am your host, Joe Clark.
And I'm Angie Kinzer.
I hope you guys are enjoying the new format. For those of you who don't know, you can watch us online as we live stream this, believe it or not, on Tuesday nights from 5 to 6 p.m. You can find it on our website, recorded, I believe, in terms of a video. It's on our Facebook Financial Enhancement Group Tidbits group page, where you're able to go in and just actually see the video. Angie and I will take a little bit further on in the conversation after the time period is up for the radio segments. So we're happy to have you join that if you would like. And you can always find our podcast, Consider This Program, wherever you listen to podcasts. So the purpose of the show, obviously, is still the same. We want to entertain you. I can't imagine listening to a boring show for an hour. So it is about entertainment, it is about information, but most importantly, we want it to be useful. So if you have a question or comment, make sure you call Angie at 800-928-4001 and let her know.
Unless you're on the live stream, you can do it right now.
Well, that's true. If you actually send it in right now, either Chris or Grant, one of the two, or maybe Darren.
Chris
is actually taking your questions right now. And putting them through. If you've got one, happy to have that. So what is this topic about, and where we
this is two different articles that kind of came together under ETFs, talking again about ETFs.
Exchange-traded funds.
Exchange-traded funds. And the first article talked about how one of the big, I believe it was Fidelity, launching 3 exchange-traded funds that will partially conceal their holdings. And so the question is this a new trend? They'll report quarterly instead of daily, and so
here's why we do the show.
Okay.
You just brought up 3 or 4 things that Casey and Andy and Levi are probably going, what the heck is she talking about? That you thought was in English.
No. Okay. I was all trying to get to one question, which is, why do the reporting cycles make a difference?
All right. So let's go back to 1923. Back in the time machine. Okay. No, Angie, you were not alive then. I get it. I know you're thinking, but no, you were not.
Oh.
Nor was I. Actually, nor were our parents. right? So this is a long time ago.
Yes.
And there was a huge crash in the market. People wanted to own investments. Think Roaring Twenties, right? Flapper Girls, the whole bit, right? I mean, it was a lot of craziness that was going on. Everybody wanted to be invested. And you had to find somebody like us or somebody who could make individual investments for you in Boston, Philly, Chicago, New York. There's probably one other place that I'm skipping over right now. And there was no CNBC, there was no fax machine. There you had Western Southern, right? I mean, you could essentially, Western Southern's an insurance company, but you know what I mean. Where you
money.
where not even really, yeah. I guess wiring would be the correct place.
I was thinking Western Union.
It was Western Union.
Oh,
That's
okay.
what it was. So, and where I had to, so Angie would say, I want to buy Coca-Cola, and then I had to keep track in my little ledger that Angie bought Coca-Cola, right? Pen and paper. This is how old I am. It's how when I had my paper route, I tracked it with hooks. I'd go to Hooks and I would buy the lined paper. Obviously, for those of you who don't know who Hooks is, Hooks became
CVS?
No, there was Revco first, wasn't there? There was Revco, and then Carmack, and then Carmax, I think it was, and now CVS. But I had this green lined paper, and I would have to write down Angie's name. I would have to write down what she paid for it. I'd have to keep track of all this stuff. It didn't work. And so what they did end up doing was creating a mutual fund in 1924. What people didn't know was that they created 3 different mutual funds. They created a unit investment trust, which is where there is no manager per se. The stocks have already been picked out. So you know exactly what it is you own, but you still own a bunch of them at one time,
Okay.
right? The second thing that you would have then was what's called an open-ended mutual fund, which is what we all have in our 401ks that use mutual funds. We don't at the Financial Enhancement Group because I won't use mutual funds. But for most of you listening to this, if you have a 401k or a 403b, you have an open-ended fund. You put money in, there's a manager or management team that takes care of it. And when you want your money out, they have to give you their money. Those were very, very, very rarely used back in the 20s. What was used a lot were what was called closed-end funds, where you put in money, the manager managed it, but when you wanted your money out, you had to buy somebody else who bought the whole kit and caboodle, as my mom would say, right? Who bought the entire fund. So you had the unit investment trust, the closed-end, and you had the open-end. Well, the unit investment trust became the exchange-traded fund, right? So there was no manager. I knew exactly what it was that I owned, right? But I wanted to have some diversification, especially in the cost of trading, right? When I started my career, it was $300 to buy or sell a stock, right? And that was my cost. So if you were moving $100,000 or $50,000 around, you were paying $1,000. Right, to do this. Today it's free, right? Cost me nothing to buy a share of stock if that's what I.
And that's pretty recent.
If that's what I sow in, well,
I mean,
for the average person walking down the street, that's a fair statement. But many times our decisions are made based on what we believe to be true from the past, not what's still from the present. So we want to be able to move that to the present and say, okay, what is the best decision for me that I can make today, based in terms of, of what's going on.
What's passive investing? What does that refer to?
So when you put money into an index fund, so most of the exchange traded funds were index, and thank you for bringing me back because I guess I skipped over that. The unit investment trust were designed by definition to be passive. Here is the 25 stocks you own.
Yep.
Right? They many times replicated what you had in the S&P 500 or the Wilshire or Moody's or the biotech index, but you knew exactly what you owned. So there was no buying and selling of those stocks. So there's no internal trading fees, right? And there's no decisions being made and there's no taxes being created. You know exactly what it is you own. That's passive. Active is when you put a manager in it. So think the open-ended mutual fund where you've got a manager who can buy and sell stocks when they want to buy or sell stocks, right? That's active. And in the exchange-traded fund space, if you will, That's what we've seen is a few of these places that have moved to actively traded as opposed to passively traded exchange traded funds. So they're using the chassis of the unit investment trust, but they're adding another part to it, if you will.
Are the passive funds less volatile than like?
You can't use volatility there at all, because volatility would be referencing the underlying assets. So stocks go up, bonds go up, they also both go down.
Okay.
And so what you would be hoping for is, if you hired an active manager, is what's called alpha. Am I getting more return for the cost that I'm paying without accepting any additional risk?
Gotcha.
Right.
I'm going to ask you a last quick question. We have some questions coming in, and this one kind of refers back to the first segment. If you file an extension, if you must file it, when does it need to be filed by? Is there a deadline?
Yeah, October 15th is the drop dead date in any normal given year. Typically by April 15th, you have to pay the money.
Yep.
And by October 15th, you have to have your final filing done.
Okay, but what about filing the actual extension?
Well, the extensions do, what would happen is, if you were filing an extension, we're taping this on June or July 14th, I think it is, July 13th, July 14th. What would happen with the filing, if you were filing an extension, is you would tell them, I'm extending my return, but here's what I owe. So typically by April 15th, you have to pay in what you owe, and you have to have the reporting or the documentation to them by October 15th, right? This year we got extended to July 15th. 2020, COVID, welcome to a crazy new world.
Right. Okay, now back to what we were talking about with the ETFs, the exchange traded funds. Chris from North Carolina asks, you always mention that you don't use mutual funds. Why not?
I think mutual funds were created and necessary, and I think they've outlived their purpose and their usefulness. When you look at reporting, and I want to know, number one, exactly what it is I own. Inside of a mutual fund, you have a manager. If you've watched me or listened to this show for a long period of time, you know that I am not stupid, nor is anybody else who's professionally managing money, where they make the decisions, where they have discretion, where they buy and sell it, based on their choice. I'm not talking about somebody who buys and sells mutual funds or sells you annuities. I'm talking about professional money managers. So we all know the same data. We all know the same things. And what ends up happening inside of a mutual fund is you own multiple funds, and you wind up owning the same stock inside of those funds. That is not diversification. That is delusion. One, it's expensive. Two, it's just not the way the world ought to work. And I can take you to every financial crisis we've ever been, and where people got into trouble was because they owned mutual funds where they didn't understand what it was they actually owned or why they owned them.
Now, I don't know if you can squeeze this one in. Cindy from Lafayette is asking, wondering what your thoughts are about the possibility of tax rates being raised or changed as a result of the billions being spent for the PPP.
Well, it depends who's in office. They're going to clearly have to try to get it back. The challenge, Cindy, and thank you for the question, the challenge is not whether or not they're going to change tax rates. The question is, how are they going to get back the $3 trillion that they put in? And unlike the tax cuts that came out of the Trump administration, where the idea was you cut taxes and the GDP grows quicker, this is a pure loss for a large degree. The first 6 months, 7 months of this year has been wiped out. They got to get that money back somehow. The argument will be whether that's over taxation or whether that's over a form of some other mechanism, if you will. So stay tuned. I wish I could answer that. Any attempt to do this through raising taxes is going to be a failed attempt. That's just my opinion. Hey, you're listening to Consider This. I'm Joe Clark, along with Angie Kinzer, 800-928-4001.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider This program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Angie Kinzer.
And we are talking about HSAs.
Yep, health savings accounts.
There you go. And I will tell you, ladies and gentlemen, I had somebody who brought in their accounts and started working with us early this year or late last year. It's been an odd year. They said if they heard me say in the shower one more time, I didn't need to know that they were hearing me in the shower, but that's how they listen to the podcast.
Yes.
If they heard me say that Google is data sensitive and not date sensitive, that they were going to scream. And obviously they were joking, and, a good part of our family, and we're certainly happy and blessed to have them. But understand what I just said. Google is data sensitive, not date sensitive. What that means is when I write an article and it's got my name attached to it, or it's got a headline that is common, right? And gets a lot of traction because a lot of you read them and share them. My newspaper column, for some reason or another, even though it's usually about tax, is relisted in China. I've yet to figure. I've tried to read my own writing in Chinese. It's just, you don't even try.
So if someone in China tried to Google you, maybe one of your articles from 2 years ago comes up first.
Exactly. And the rules for HSAs have changed. So there's a difference between data and date, right? So when you have a new change in the tax code, many, many times those stories are buried because there have been so many stories written about stuff the way that it was before. HSAs are one of those.
So can an HSA be used for retirement savings?
Yes, it can.
Okay.
And so unlike, because I used to have people who believe this to be true, unlike a college choice or a 529, where people thought you could convert that to an IRA, you cannot. If it's not used for higher education, welcome to the penalty and the taxation. In an HSA, that is not true. You can very much flip it and turn it into a retirement account if you want. All of us, I guess maybe there's somebody who's not, but most of us are going to have Medicare Part B premium payments,
Okay.
right? You can take money out of an HSA to reimburse yourself from that. So if you put money into a health savings account, and your employer, this has to go through your employer, and you've got to have what's called a high deductible insurance plan. So not everybody's eligible for them. But this is something that I would try to get people to go out and get. It would be part of the negotiation. We clearly have one at FEG, right?
Yeah.
Right. So I put money in, and Barb and I have medical expenses, right? I mean, we still have stuff that we need have done every year, but we don't take any money out of the HSA.
Right.
Right, because it's continuing to build tax-free, in a growth account that we will turn around and use when we are over 65. I hate to say the word retire because I can't imagine me being retired, but we'll use it later.
I've only used mine a couple of times, and I noticed just recently here when I filed my taxes, it asked me the question, because I know you're supposed to only use it for medical purposes, and so on the tax return it says, did you use it for a medical purpose? And you just say yes.
Yeah,
who checks that stuff?
Nobody, because it's almost impossible. So one of the things about our tax code, which is kind of, I had to figure out how to put this politically correct. One of the challenges is it's a self-reporting process.
Okay.
Right, you are supposed to tell on yourself to pay taxes. Now, we already said in the last segment, nobody wants to pay more taxes, right? And with very rare exceptions, twice, in 32 years, have I found that person that wanted to raise their hand and go, no, I should pay more,
Yeah.
right? And people
Well,
who
that lady.
and people who lie on TV. That's what I said too. I mean, she was one of them, right? And probably her poor ear-drawn husband, because she drug him out of the place, as you recall. So it's a self-reporting process where you say, hey, this is what it is that I owe. And then the IRS has mechanisms to be able to come back in and say, I don't think so. Well, think about the challenging of that, right? It's really, really expensive. So the IRS will give you rules that says you can deduct this, you can't deduct that, right? Things that are computer matched, like 1099s, you never want to mess that up, right? Computer things that are matched where one institution says you took money and you say, oh, no, I didn't. Well, the computer's going to audit you and go, Ms. Kinzer, either tell us why this is wrong or send us a check for this plus the interest and penalty.
Right.
When you have things like that, it's a whole different story, right? I mean, it really is. So keep track of it. Be honest. Those of you who listen to the show are not trying to cheat. You're just trying to be efficient. And that's really how we try to help you reduce financial regret.
So we got one more day before the actual deadline. What if
you're watching the streaming, not if you're listening to it Saturday morning.
No, not on Saturday morning, but so the 15th. What if I wanted to go out and make a contribution yet today? Can I still do that for last year?
So here's where the tax code gets to be really, really interesting. When I got into the industry back in 1987, I worked until literally December 31st every single year. Right? I mean, we were doing stuff all the way up till midnight of trying to get it done. Try to get younger people to work after Christmas is we have 29 people in our team, and I think half of them want that week off. Right? I mean, we custody at TD Ameritrade and Schwab. Those are the two places where we keep all of our assets. And they send us a letter. I think this year was December 12th. For 2019, it said if you don't have something done by then, we'll not guarantee that it's done. And you're what? You got 28 days left, and you're telling me you're not going to guarantee it?
I've seen it happen with College Choice too.
Yeah,
we've tried call.
Yes. So there's a difference between what the tax code allows, Angie, and what you're actually capable of accomplishing or getting done.
Well, and I guess the whole point is.
But yes, tomorrow you could show up and make a deposit.
And really all we're saying is that you can still contribute to something for last year up until your deadline the following year.
Yes.
So I think that's
in an HSA up until the filing date, which is typically April 15th, right?
Yes.
So for IRA contributions, things like HSAs. But for most people, the HSAs are taken out of their accounts while they work. At FEG, we're a little bit different.
What about your Roth?
Same thing. You can contribute to a Roth up to tomorrow. If you did not contribute in 2019 and you were eligible for that, you can contribute. You cannot do a conversion. Do not confuse the two.
What if you don't have the money, like right now, to contribute? You're young and you know you should contribute to a Roth. You don't have the money right now, but then say later next year you have enough to contribute for 2 years. Are you allowed to go back at all?
No.
Okay.
But that's cute. Right? That's thanks for playing. Appreciate your no.
Okay. So
Doesn't work that
last
way.
question about the HSA. How much time do you have to withdraw your HSA? I mean, you've been contributing forever, and then is there a certain date that it's now time to take it out, like an RMD?
Nope. Rolls into a spousal HSA if you need it to, or into a spouse's IRA if that's where you would want to go. I would pay very close attention to these rules, and if you have an HSA that's eligible, I am not, and I go back and forth on this, but I am probably 90% right now, Ange, that I would fund my HSA before I would fund a Roth.
Really?
I think the opportunities, provided you can, you've got a good HSA to invest it in. Right, a lot of the places it's kind of like dead money. You just put it in an interest-bearing account, and obviously they pay no interest.
You just answered the question that came in from Tim from Lafayette, and he was asking if it's better to contribute to your HSA or your Roth. So that's interesting.
Tim, it's a great question. I've gone back and forth on it, but I think, and fortunately, I use a backdoor Roth IRA. I don't qualify for a Roth IRA directly, but we use a backdoor strategy that we've talked about on this radio show a lot. If I had to pick between funding our HSA and funding that backdoor Roth, I believe I would probably take the HSA today. So if you're younger, I think there's more options there, but you do have to make sure that it's an investable place, right? We spent a lot of time where ours was in dead money. And it's because my wife was using the money and I wasn't paying attention. We get a statement that said we had $1,000 or $2,000 in it. Okay. Well, now a couple of years of not using it, now we got money,
it adds
right?
up. Okay, so we have another question from Billy in Texas. Is there a limit on how much I can contribute to my HSA?
The HSA is limited as to whether or not you're married or not and how your plan is. But there is a fixed amount of money that you can put in. And there's a reason, Billy, I have a team of 29 people. But thank you for the question. That is not one I have to know the answer to. It seems to me like it was around $8,500. But I don't know.
Which is more than you can put in your Roth.
It's more than I can put. It is more than I can put in my Roth, but I think it's because I think it's because we're married. So in our Roth, I can put in $7,000, and Barb can put in $7,000 if we were eligible to contribute. But I think it's somewhere around that. But yes, there is a limit. Otherwise, we would put a whole lot more money into them, and there is no ability to convert money into an HSA yet. That doesn't mean that there won't be. I think there's a lot of the tax code that's going to have changes that have to take place.
Alrighty.
What do you mean, all right?
Alrighty. Good to know.
Hey, folks, if this has helped you, and that's our job, make sure you call Angie at 800-928-4001 and get signed up for a Next Steps meeting. We will promise you in 90 minutes, we will sit down and we will give you things that you're going to want to consider today, things that you will want to consider in the future, and if we choose to partner together, things that the Financial Enhancement Group will do for you. You can always go to our website at yourlifeafterwork.com. But again, give Angie a call, 800-928-4001. We are more than happy to sit down with you and help direct where you are financially. Our objective is to help you reduce financial regrets. We'll take a break and we'll be right back.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Well, good morning and welcome back to Consider This program. I'm your host, Joe Clark.
I'm Angie Kinzer.
We had a great question that came in from Angela from Newcastle, Indiana. So we've had North Carolina, we've had Tennessee, we've had Lafayette, Indiana.
Yes.
I don't remember any from Indianapolis. You guys must be sleeping tonight. Anyhow, great question. Can you fully fund a Roth, meaning a Roth IRA, and an HSA? And Angie, the answer was?
Yes.
If you qualify for both,
qualify,
right?
yes.
You do have to qualify for both of those things. So you have to have a high deductible account at work, and you have to have your income high enough but low enough to qualify to make a Roth contribution. Assuming those are true, you're in good shape. I am part of a group with Ed Slott in the world of IRAs, and you can go to IRAhelp.com. In the world of IRAs, there's a group of us there's about 400 of us now. It's 379, I think it is, of tax attorneys, CPAs, and geeks like me who read private letter rulings and tax codes. I know.
It sounds like the worst.
It's the greatest. I mean, you would not believe how stupid
How do you
some
stay
people are.
awake?
You can't fix stupid, right? And you read some of these private letter rulings where people tried to deduct things, and
I guess
it's
that
kind of
would be
like,
funny.
you've got to be kidding that our courts have to address your stupidity, right? But this is good stuff, and we compile things all of the time. I'm a checklist junkie. You can go to our website at yourlifeafterwork.com to get our checklist. These are 12 things to consider for RMD waiver questions. RMDs are required minimum distributions, and a waiver is we're in this crazy 2020 where things have changed. They will go back to where they were in 2021.
So what's the waiver mean?
Waiver's a change.
Right. So
I waved you through. I mean, that's the best way to, if you want to think about it from the English language.
So if you turned 72 this year, you were supposed to take an RMD. So if you got it waived,
Well, so now you probably just had
What?
people wreck their car, right? Because if prior to December 20th of 2019, you didn't have to take a required minimum distribution until you turned 70 and a half.
right?
Technically, it was the year after the year you turned 70 and a half, but if you waited until then, you had to take 2 distributions, the first being before April 1st, right? Now that confuses most people, right?
Yeah.
So they decided that was crazy. So December 20th of 2020 or 2019, effective January 1 of 2020, right? They changed it so that you do not take required minimum distributions until you're 72 years old, right? Now, that didn't mean you can't pull money out of your account. It just means you weren't forced to pull money out of your account until you turned 72. And then we got this virus thingy, right? That just changed everything. And so the CARES Act was passed March 27th of 2020 that said, hold everything. I don't care if you're 79. I don't care if you're 86. I don't care how old you are. You do not have to take a required minimum distribution this year if you do not want to. You were waived from having to make that withdrawal. Now, part of that was because in March, the markets were down 35, 40%, right? And so people are being forced to take money out of accounts that they believed would go back up, and certainly did, right?
Yeah.
That was part of it.
Yeah.
And secondly, they didn't want to create any more stress in people's lives. My big thing, and hopefully you get to this because you're in charge of all things questions on Consider This program. My big thing is just because you don't have to doesn't mean you shouldn't. I didn't have to get up and do yoga this morning, right? I did have to let Othello out, right? I mean, if I didn't let Othello out, I was going to get pain, right? Because I was going to have to clean up a mess, right? If I didn't do yoga today, nobody's going to know, right? Nobody's going to say anything, right? There are days when you look at required minimum distributions where I think people fail to understand how the tax implications are going to work in the future, that should be taking it this year that may not because they don't understand the choices and all of the things that go around that.
So it must have generated a lot of questions because what we've put together are the top 12 questions. So who knows how many questions there actually were. But let's just try to get through some of them. My RMD is sent to me automatically on a monthly schedule. Even though I already took a portion of my 2020 RMD, can I stop the remaining monthly payments?
Yes, and put back the ones you got the last 60 days. And I'm not so sure by the time the year is over, they're not going to let you put it all back if you want to. But certainly the last 60 days and certainly the amount of money that you have yet to take out.
My 75-year-old father passed away in January without taking his 2020 RMD. Now my siblings and I are establishing inherited IRAs. Do we need to take his year of death RMD?
So this is a tricky question. My 75-year-old father passed away in January. That is 2020.
Yeah.
So as of January 1st of 2020, your RMD no longer goes to an inherited IRA. People are calling it that, but they are mistaken. It is now going into an account that is going to be held for 10 years. In an inherited IRA prior to January 1st of 2020, you would have had to take out required minimum distributions because your father was over 75. You would have to have taken it out over his life expectancy. He's dead. That cracks me up. How do you use a life expectancy of a dead person? Believe it or not, there's a chart. Would you have needed to take his year of death RMD? And the answer would have been, yes, you would have needed to take it if he'd died last year.
Right.
This year, you don't have to take it but you don't have to take it for lots of reasons. There is no required minimum distribution for somebody who died. You've got 10 years to pull the money out of the account.
Okay, so Chris from McCordsville is asking, what sort of planning can be done by not taking an RMD this year?
I would use it to if I was not taking money out of an RMD, what I'd be looking for is money that I could use to take out of another investment at a lower tax rate. So it could be the sale of another stock. It could, so think about offsetting capital gains tax. If you happen to be in the first two brackets, the 10 and the 12% marginal rate, there is effectively no long-term capital gain tax. It's zero. You have to know how to make those numbers work. But that doesn't mean that it's in your best interest. I think there is no plan that ever occurred that was better for the life insurance industry than what happened December 20th of last year, and none better for people to do legacy planning. The things that I've done in my life changed because of that tax code, and I'm 53. I'm a long way away from 72. Thank you very much. And I've changed things that I have structured because of that code.
Okay, here's the magic question, number 3. Should I still take my 2020 RMD?
Again, that's going to get into that tax planning. All right, that's going to get into what makes the most sense for you. You really have to look at who the beneficiaries are and the heirs and the probability of you using the money. So my tax rate today is higher than my daughter's, who's in nursing school. That shouldn't shock anyone, right? She doesn't have a job. She's in school. I have a job. Hopefully my tax rate is higher, right? What happens as we progress as parents in a capitalistic society is our hope is that my daughter's tax rate is higher, right, as she ages, and that my rate actually goes down as I begin to age and go into quote unquote retirement. I mean, that is the typical cycle that you would watch. Your tax rate goes higher at peak earning years, and then your tax rate goes down as you age. That's what most people would expect. Under the new rules, when something happens to me and Barb, my daughter will inherit the money if I die on time, which is it's my joke, right? But we're supposed to die at 84 and a half, right? Got it written on a calendar, right? That's my life expectancy.
What day does that fall on?
You're waiting for a party, aren't you?
Yes.
I'll fund it. It'll be okay. But when we look at this and you think this out, if I die on time, in theory, Kendra's tax rate is the highest it should ever be. And all of a sudden, she has to take all of the money out of my IRA. So if I can take money out of my IRA today at 10% or 12%, as opposed to trying to figure out what it is she's going to have to take it out, if I'm really in the let's preserve assets for the family, then I need to be taking that money out. And that's exactly what's happening with RMDs. Every year we have people who show up who've never been with us before, who've had CPAs who've done their tax returns. They've paid zero to the IRS and have $1 million to $2 million inside of IRAs and 401ks, and nobody told them that they should have been taking money out. So the word required minimum distribution, I think, leads people to believe that they need to delay. And in many times what you really need to do is to accelerate. But what you need most of all is a tax plan that says, hey, here's how I want to look at it.
Since RMDs are waived for 2020.
We're now 4 of 12, by the way.
Yeah, I know.
I would recommend getting the checklist.
Yes. Since they're waived for 2020, if I decide to take it anyway, does that mean there's no tax due on the withdrawal?
That would be correct. If you do not take it out, there is no tax due.
If you do take it.
Oh, if you do take it out.
Even though,
well, so this is an interesting part of the deal, because part of the COVID deal, you can actually take up to $100,000 out of an IRA or a 401k this year and defer paying the taxes on it over a 3-year period of time. That is another major tax planning strategy. Not that we're talking about here, right? So this is where this gets.
It is so confusing.
Gets grainy.
And especially back when you said, when it was 70 and a half and you had to pay 2 the next year if you waited a year and this and that. Because here's a question number 7 was, will I need to take both my 2020 and my 2021 RMD next year?
Nope. You're still only having to take the one. And I'm pretty certain it's all the way up to August of this year. If you've already had money come out of an IRA, if you want to put it back, you can put it back. But we've got people to help you with this. That's part of the deal. And like I said, give Angie a call. It's 800-928-4001, or go to yourlifeafterwork.com. Get signed up for a Next Steps meeting. We have CPAs on staff, CFAs, CMTs, EA, CFPs. We've spent the time and the money to be able to have the education to try to help this, but it needs to be coordinated. As you've seen on this show, myself alone, I can't do this. There's a reason we pay 29 other people on this team to be able to do what is required. It is complicated. And in a world that is changing this quick, you do not want to get caught behind the 8 ball and miss an opportunity. 800-928-4001.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program as about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
Well, good morning and welcome back to Consider This Program. I am your host, Joe Clark.
And I'm Angie Kinzer.
Happy to have you along, Angie.
Yes.
And everybody else.
And everyone else. So, everything else has changed with the whole COVID thing. So, one of the articles that caught my eye was how it's changed for career choices in college. And so what they've done is, this sounds kind of negative to give you the top worst college majors for a lucrative career right now. So I'll skip to the next one, which is jobs that were hurt most by the coronavirus. And this is what they're telling the kids who are declaring majors right now.
Okay.
So just some of the things that are hurt the most: pilot, plumber, which doesn't make sense to me. Your pipes are still going to break.
I want to know your source.
It is Kiplinger's.
Meh.
You sent it to me. You sent the article to me.
They are telling you that becoming a plumber is a mistake.
These are during the COVID.
Now, I will tell you, spending 4 years in a university as opposed to going through an apprenticeship to become a plumber, that I may have a different opinion if I had to stop and think that through. But,
okay, it's got cook, fitness worker, hairdresser, bus driver.
Okay, so I like Mary Beth Franklin. I get a lot of research from her, who used to be at Kiplinger. That's where I really get attached to them. I will forward you no more articles from Kiplinger. That's insane.
You're just mad about the plumber.
Well, no. Okay. Well, no, all of them are. So what happens is in a period of shock, people try to extrapolate what this is going to look like forever. Right. My trainers, I have 2 of them. I guess I'm especially needy. Are doing as well as they've ever done because we're doing it all over Zoom where they can. And they've picked up people out of state that they used to work with that have moved away or been transferred. I ain't buying that. Cooks are doing phenomenally well. I think that
if their restaurant's open.
If their restaurant is open, that part is true,
yes.
Right? But that does not mean that we are going to go away from our gastronomic love of eating, right? And trying to find good cuisine.
And we were really worried about our church in the beginning, having to go to all this Zoom.
I'm still worried about my church.
Ours is growing.
Well, I know
because of being on this. Of course,
I need my church back. Somebody asked me earlier today what was wrong. Well, we keep canceling things I care about, and I haven't been able to go to church except online for about the last 3 months, and I love to hug. Other than that, everything else is just perfect. Just peachy. Hey, folks, we appreciate you tuning in. Give us a call, 800-928-4001. We would love to help you reduce financial regrets. Take care and have a great week.